Welcome back, you legends. I'm Dr. Cal, and this is going to be just a daily update. I'll do a full weekly analysis, hopefully, God willing, by Sunday. So let's jump right into it. This is the stock market map for today, Friday, the 18th of August. We have a bit of a mixed look. We're still seeing cyclicals like Amazon and Tesla continuing to sell. We saw new weakness in Google. We had AMAT report earnings and doing well. So that could mean that Nvidia may not miss next week. Remember, Nvidia has earnings next week, and everybody's watching this name, waiting for that AI bubble to pop. You really have no idea whether they're going to miss or beat. Microsoft, Apple basically flat on the day. Defensives like Walmart, Coca-Cola, Philip Morris did okay. Eli Lilly just continues to rip. This is a healthcare name that is getting kind of crazy in terms of valuation because of a new drug that is very close to getting approved. We had healthcare plans doing okay. This is a defensive trade. We had aerospace and defense names kind of doing okay today. So a bit of a mixed trade today. If you take a look at the daily chart, the markets were basically flat on the day. The Dow Jones slightly up, Nasdaq slightly down, S&P basically flat, Russell 2000 up half a percentage point. If we take a look at the different sectors today, again, energy leading, defensives and utilities in second and third place. Weekly relative performance, look at this tech. Tech did okay this week, surprisingly. And I think it has to do with the fact that Nvidia was actually up on the week, 6%, if you can imagine. Nvidia closed this week up. This just goes to show you how strong these bubbles are getting. Nvidia is absolutely in a bubble, and it's still holding up. I mean, I'm kind of amazed at how well this name is still holding up. In contrast, look at Intel, down 6%. But that's what happened. Tech did the best this week. Can you imagine that? Tech did the best, and that's because Nvidia was up. Microsoft, Apple, Google, Amazon, Tesla, Meta, all down. But Nvidia did okay, and that means next week's earnings report is going to be a market-moving event. Because if Nvidia could hold up the tech sector and make it the least, or I should say the best performing this week despite the massive selling, it could do some serious damage next week if it misses. I mean, this is probably going to be the biggest trade, whether the Nvidia misses or maybe it raises guidance even more and explodes to 1,000. God knows, this stock is getting crazy. So let's jump right into the daily chart for the S&P 500. We opened with a gap down, then we had a recovery. We closed pretty much at the close of yesterday. This is a very basic looking kind of price action today, and primarily led by maximum pain. We got it. We hit maximum pain this week. It started at 440, then it was walked down the entire week. At the end of yesterday, it was at 437. We got to 436 and a half. We closed at 436 and a half. So we're basically there. We basically achieved the goal of maximum pain, and we can check that off our checklist. Now, in terms of where price is, it's kind of interesting. It's in the middle of nowhere. We're in the middle of this cluster of trades back here in late June and early July. This is a clear gap at 431. I was hoping to see a gap down just like what we had today, then continued selling down, fill the gap, and then move back up. I think that would have been a bottom, a reasonable bottom if we had continued down, filled the gap, and then recovered. But we did not sell off at all at the open. We saw immediate buying. In fact, if I take a look at the 10-minute chart, look at that. Immediately got bought up, never got back down to 433 just at the open, and that was it. We just continued higher for the rest of the day, but the trend was fairly weak. This still looks like a bear flag, right? Still looks like a bear flag. Aggressive selling to the downside, anemic recovery. That's what a bear flag looks like. If we take a look at a full measured move, top to the bottom, let's take a look here, top to bottom, down to 430. So this is still could be a bear flag. Now the volume on the day was significant. I was watching the volume throughout the day, and it was a really great volume until the end of the day. We had that spike. We made a higher high in terms of volume today. So volume traded today was higher than all previous days. So that is significant. Volume is rising on this green candle. We just need confirmation. We could see some more upside here. I'm not seeing confirmation yet. We take a look at the 1 hour chart. We had a cross up, a bullish cross on the stochastic. We've been waiting for this cross for several days now. And so we finally got it. So we should see some more reprieve, potentially all the way to 440 to the upper edge of this new chop box that I expect to be filled next week. I think we'll get more chop next week. We're looking at 440 because it acted as support here, and then once we broke through it, it will act as resistance. Right, we had a lot of trades here, and so this should be an area of interest. I would not be surprised to see continuation back up to 440, and then maybe we can come back down, form a double bottom, and finally form a tradable medium term bottom at 430. Now, if I look at the weekly chart, let's take a look at the weekly chart. The weekly chart is actually interesting. If you take a look at the weekly chart, it doesn't look that bad. Here's what I mean. It doesn't look like a bear market breakdown. It doesn't look like that yet. It just looks like a correction, a pullback so far. We have the 20-week moving average, this dark red line here. This is the mean reversion moving average. So we haven't even mean reverted yet. Mean reversion right now is at 430. So again, probably 430 will act as major support, especially if we look at several charts here, weekly, daily, many charts. We have this clear neckline at 431, previous resistance back here, support here. Once we broke through it, back tested, continued higher. And again, likely once we hit it again, we'll see some bounces off of it. Now, the question is, how high is the second bounce going to be? Well, if it stops here, that will form a clear head and shoulders top. If it continues higher, it will tell us that this is just a correction, and we'll see an even higher high than 460. Or actually, how high did we get? 459.98. Very close to 460. So that's kind of what we're looking at now. We're looking at this mean reversion moving average, a 20-week moving average to hold. We're looking at a bounce coming up in the next, let's say just we get a lot of chop next week. Maybe we go down to 431 and then bounce back up. And then the latter half of August, we'll see a bounce back up. If it stops at this prior high at 444, that will confirm a head and shoulders top. If it continues higher, it will likely contest this prior high and fill this gap at 460 that we haven't yet filled. Okay, so let's play out these scenarios. Here's the left shoulder, right shoulder. Maybe we get a right shoulder here. A bit of a choppy period here, right shoulder. If we get that, if the trade stops here, we'll get a break of 430 and we'll continue lower to 420. If we move higher, if we take out this prior left shoulder, if we take out this left shoulder, price is more likely to continue higher to fill the gap of 460 and potentially even take out this high. Now, in all major stock market tops, what often happens is that we make a higher high. Here it is, a higher high than all of these previous highs and a lower high in the PPO that establishes a negative divergence. And it also establishes a negative divergence with the Russell 2000. The Russell 2000 tends to lead the market. And here it is. Let me add the S&P so you guys can see what the heck I'm talking about. Here it is. So the S&P up above and in blue and black. And this is the Russell 2000 down here. Look at that. Perfect. Negative divergence here. Lower high on the Russell, higher high on the S&P. That marked the top. We just had that crackdown. We took out this low, and that was it. We made lower highs and lower lows from that point on. And I bring that up, guys, because I'm hearing a lot of folks calling the top here, the stock market top, the bear market top here. And I'm honestly not ready to call that top just yet, based on that fact alone. Based on the fact that we usually form a negative divergence first, and that marks the top. If I add the, let's add the Russell on this chart, and let's see if we do have a negative divergence. Do we have a negative divergence? Right, we have a higher high here, a lower high here. This is the Russell down here. There's no divergence, right? The Russell moved on to make a higher high, just like the S&P. The Russell had stopped at this point, right, made an equal high or a lower high, I would have been more eager to potentially consider this as the top. So far, not ready to call that the top just yet. It's also essential, guys, to talk about bonds, long-term treasuries. And here's why. Very often, guys, TLT, the long-term treasuries, will begin to rally before the market actually tops. And I need to show you what happened in 2008 so you can, guys, understand what I'm on about here. Okay, here's the long-term treasuries in mid 2007. Okay, this is the S&P 500 down here. This is the long-term treasuries. Long-term treasuries made a double bottom here, and they began to rally. They took out this high right here. Let me add a vertical line. Boom, we made a new high here on the treasuries. Do you see that, guys? This is the new high on the treasuries. Do you see what I'm seeing? Do you see what happened with the S&P? So the treasuries made a new high. The S&P 500 made a lower high. Okay? So that's kind of how you spot weakness in the market. You would begin to see money flowing out of the stock market and into treasuries. Money is not buying treasuries now. They're not buying US treasuries because yields are still rising. The Fed is not done potentially raising rates. TLT usually begins to break out, make a new high when the Fed begins to cut rates. So we're probably looking at 6 months out, probably looking at still 6 months out from that happening. And we could potentially right now be here, right? The second to last high. Not necessarily the final high, but the second to last high. So the Russell 2000 is not calling this the top. The TLT is not saying that this is the top. And we have to pay attention to that. More so than that, if I actually look at the yield inversion chart, this is the 10-year yield divided by the 2-year yield up top. It is still deeply inverted. I still have some annotations, some drawings from the last time I talked about this. And I still have the same view. And here's the view. We need to see the yield curve begin to steepen again. Exit inversion begin to rise again. When it exits inversion, when it goes above 1, again, that's when the actual market top develops. Down below here, guys, is the moving average for the S&P 500. I hid the candles. Let me show you what the candles look like. Here they are. Okay. So what are we looking for? Let's look at 2007 for some clarity. Here's 2007 on the yield curve. Here it is. This is late 2006. The inversion began. We exited inversion in the middle of 2007. Here's the S&P 500. Okay, so this is the middle of 2007. And the market was beginning to top after the yield curve began to steepen, after it exited inversion, after it went up above 1. We're still below 1. We're still not there yet. Now, if I look at the weekly chart for the S&P 500, we're still nowhere near the 200 weekly moving average. In fact, we bounced off it last year in October when we made that October bottom. That was the low for the year, and we had successive higher lows since then. The low in December, then a slightly higher low in March, and then when that March sell-off failed to make a new low, we had that volatility contraction rally that I began to talk about as we began to really form that volatility contraction in April and early May. Let's talk about the elephant in the room, that is the Nasdaq 100. It broke that key trend line that I talked about yesterday. This is a massive development because there's really no support at all. There's no support at all for the Nasdaq all the way down to 332. What's at 332? Well, we have this gap. Here it is, 332 exactly on the dot. And we have this other gap at 332 and the prior swing high from August. And in fact, today we closed below the trend line. We opened below it. We tried to recover it. We closed below it. And volume today was lower on the Nasdaq relative to yesterday. while on the S&P 500 volume today was actually higher. That tells me that there's going to be still more weakness for the Nasdaq in the weeks ahead into September and October. So that's often what happens. Usually seasonality, guys, is very negative for the Nasdaq in August, September, and October, and it's actually okay for the Dow Jones. So it's okay for value, and it's pretty bad for growth. Even the S&P 500 tends to suffer in August, September, October, and even November in pre-election years, and really begin to open the taps in December. So this is the seasonality for the Nasdaq. Here's the seasonality for the Dow Jones, and here's the seasonality for the S&P 500. Looks pretty similar to the Nasdaq, right? Very similar looking seasonality chart. The Nasdaq, we usually get a sell-off into early August, then a recovery into mid-September, lower high. Then we continue lower, make the bottom for the year at the end of October, and then begin to recover in earnest. S&P 500, kind of the same look. Weakness in early August, a rally into mid-September, sell-off into late October, then a recovery towards the end of the year. The Dow Jones actually does okay in August and September, right? It tends to outperform the S&P and the Nasdaq, but yet again, it comes down, forms a bottom in October, then it begins to rally in December. So the differential is in August and September, where the Dow, or value in general, tends to outperform growth. And in fact, if I look at value divided by growth, Vanguard value divided by Vanguard growth, here's the chart up top at a double bottom. We bottomed in August on, or in late July on this relative chart. That's when value began to outperform the growth trade, and that's actually when the Dow Jones began to outperform the rest of the market. Here's exactly when the Nasdaq topped. This is the Nasdaq down here in blue and black. It topped in late July. The S&P ended up topping about a week later, making a slightly higher high. Here it is, a slightly higher high versus late July. So the Nasdaq topped first, and then it began to lead the market down, and it's continuing to lead the market down, with the exception of this week. This week, tech in general did better. This week, tech in general did better because of Nvidia, right? The weekly relative performance, tech did the best this week just because of Nvidia. And that brings us to the Nvidia chart. What are we looking at on Nvidia? Well, we had that exact same support line that I showed you on the Nasdaq that broke yesterday, and we failed to recover it today. Nvidia actually broke that chart a couple of weeks ago. We had a back test of the 20-day moving average, rejected. Today we had some buying from Nvidia. It made a higher low, while the Nasdaq made a significantly lower low. Look at that. Vastly different looking chart. But Nvidia stands to lose the most if it misses on its earnings report next week. It doesn't really even have to miss. If it just guides down, I think that will lead to a breakdown. So just a guide down for Q3 will lead to declines in Nvidia. It doesn't even have to miss this quarter, and that's really the big question. So what happens if Nvidia misses? Well, if Nvidia misses, most likely we open post earnings below this neckline. We're forming this, I think it looks like a distribution, a Wyckoff distribution pattern, right? We had a high, higher high, BTAD final high, here it is, then anemic lower highs. This looks typical of a Wyckoff distribution. This is the Wyckoff distribution pattern. Do you guys see the similarities here? Do you see them? High, higher high, final high, lower highs, break of neckline, sell off, right? High, higher high, final high, the UT, lower highs, break of neckline, we're still waiting for that break, and then continuation, right? It looks exactly the same. 1, 2, 3, lower highs, break. 1, 2, 3, lower highs, and now we're waiting for that break. Now that's assuming Nvidia sells. Now this could be a super bubble. We just don't know. This could be an insane super bubble, and Nvidia could go even higher. Nvidia could rally to this resistance line. This channel stood the test of time. This channel lasted for years and years and years. This channel goes back all the way to 2016. Ping pongs goes to the highs, back to the lows, goes to the highs, back to the lows. Does it hit the highs first? Do we rally even more? Do we go up to 700? I mean, nobody knows. Honestly, nobody knows. Objectively speaking, looking at the chart, looking at Nvidia's insane guidance, looking at the history of Nvidia, raising guidance, then missing, like what happened here in late 2018. That's exactly what Nvidia did back then, guys. It raised guidance, then it missed the next quarter and had this massive crash. So objectively speaking, I think we lean toward a breakdown instead of a rally. There's no way of knowing, but that's kind of what we're seeing with the Wyckoff distribution, with the Nasdaq breaking that key trend line, with the Nvidia breaking its own key trend line, with Nvidia potentially and forming this Wyckoff distribution pattern, this head, okay, this final head. This could be, this entire price action here could end up being an island reversal. We gap down below the neckline post earnings, continue to sell off. This would be a perfect island reversal. What else do we see that can help us? Well, the PPO is about to cross the zero line. It's not there yet, but it's getting very close. Once the PPO crosses below the zero line, that's when you get a major change in market behavior. You don't see dip buying, instead you see rally selling. Rallies get sold. They make lower highs. That's what tends to happen when the PPO crosses the zero line. You get this switch in psychology from buy the dip to sell the rip. Okay, in terms of an objective target, what are we looking at? Well, we're looking at this gap at 305. We're looking at the back test of this support line that held throughout this insane rally in Nvidia. We're looking at a back test of this exact support line. A back test of the support line into mid-September looks like a back test of 300. So even if we don't get a precipitous sell-off right after earnings, we could just get a gap down and then slow grind down to backtest this trend line into September and in October. The slow boiling frog. And these are the worst, right? Especially for investors. Because if you're not paying attention, you will just continue to hold thinking, okay, this is just consolidation. And then boom, right? You get the rug pulled from underneath you. So back to the Nasdaq. What does the Nasdaq look like right now? It looks like a breakdown of this key support line. Let's take a look at the Nasdaq composite. Do we have the same break? Let's try to connect the lows. Okay, so the Nasdaq composite is on the precipice of that break. It's on the precipice. It just tested it today, but it did not break yet. The Nasdaq 100 has already, and quite often the Nasdaq 100 tends to lead the Nasdaq composite. But with that being said, the oscillator is at deep red territory. Often at these deep red territories is when we see market bounces and potentially just short-term bottoms, sometimes long-term bottoms. But quite often, guys, we need to see two of these, right? A double dip, a double bottom. That's often when the low holds. We had a low here, another one here. The final low was here. And this was a great one because we had this beautiful bullish divergence on the stochastic. S&P made a lower low. Stochastic made a lower, I should say, excuse me, the oscillator made a higher low. So that was a beautiful bottom. Again, another one here, low, another low. No divergence here. We just recovered after the Fed intervened. So this was a news event-led recovery, not a technical one. And then we just continued to rally. Another one is here, a low, another low right here, another low here with a higher low on the stochastic, oscillator. I keep saying stochastic. Significantly higher low on the oscillator. One final sort of watershed moment, capitulation. Even higher low on the oscillator, and then that was the bottom. Another one here, extremely oversold. We went on and made a lower low on the daily chart, higher low on the oscillator. That was the bottom. So that's kind of the typical structure that you would look for a medium term or a longer term bottom. A bounce here that fails, a bounce that comes through here, it fails, it makes a lower low, right? Higher low on the oscillator, and then that should be an interesting tradable bottom. So when does that low come in? Well, on the Nasdaq composite, we're looking at 12,500. On the Nasdaq 100, we're looking at 13,600. On the triple Qs, we're looking at 332. Okay, let's take a look at the Dow Jones now. The Dow Jones filled our target gap of 342.9 today. Perfect gap fill target. What happens next with the Dow Jones? Let's try and draw a support line here and see if we have any connections. Well, we could see some more downside on the Dow Jones, and this support line would still hold. So that's looking better for the Dow than it is for the Nasdaq or the S&P 500. And if I take a look at the Russell 2000, this is the daily chart, went back down to the 200-day moving average. We are looking at this gap to be filled, this gap at 176. And if we get a gap fill here, then we move on to make a higher high, right? If we continue to make a higher high, we should see the S&P do the same thing and move on to make a higher high, potentially even take out the all-time highs from late 2021, early 2022. Maybe something that looks like this, right? Then we come down in early 2024, make one final high. That was it. While the Russell 2000 goes on to make one higher high, then a lower high, negative divergence, and that's all she wrote. And very importantly, guys, next week we have Nvidia reporting earnings after the market close on August the 23rd, and we have Jackson Hole on Wednesday, August the 23rd through Friday. Wednesday, Thursday, Friday. We have 3 days of Jackson Hole next week. So we'll hear a lot from the Fed next week, and we have Nvidia. And so we have two major risk events. One is the Nvidia earnings, and the second is the Jackson Hole Symposium. And we can tell a lot about what's going to happen with how price action develops ahead of the symposium, ahead of the Nvidia earnings. If we get a rally ahead of both, we get a rally all the way. Let's just go crazy. Let's go all the way back to back test this resistance line at 440, for example, something like that. If we move all the way back here, if by Tuesday, Wednesday, we're back here, I think that leans more bearish. I think that leans more towards a break and a sell-off all the way back down. If by contrast, if we're already at the neckline by that point, at that point we'll look for a bounce post earnings, post Jackson Hole. So it really depends on what price does beforehand. Quite often what price does before the event is the opposite of what price does after the event. If you see the market sell ahead of a key event like CPI, it usually rallies post CPI. Pretty much like what happened here. The market was already selling, it rallied on CPI. Because if the market is pessimistic heading into an event, it is more likely to be pleasantly surprised after the event. If it is bullish ahead of the event, it's very optimistic. It is more likely to be disappointed after the event. So to summarize, let's go through this very quickly. Gap down today, a rally to the upside. We failed to close above this fast moving average, which tends to mean that we're still in a downtrend. The stochastic is beginning to cross back. So price action is trying to recover. The stochastic is trying to recover, not there yet. That opens the door for a lot of chop until these moving averages begin to flatten, until price actually begins to regain this fast moving average, this green line. Once that moving average is regained and this leg of selling ends, we form a tradable bottom. We go back, potentially backtest either this resistance line or these prior highs at 444. And at that point, if this fails, we likely move down and close below the neckline. So we're thinking about a lot of chop here, something that looks like this. If you're bearish, if you're bullish, you want something that looks like this. Go back to the neckline before Jackson Hole, before Nvidia reports. Nvidia beats, Nvidia does amazing. We go back and we close back up above these resistance levels. And at that point, I think the market continues higher, fills these gaps up above, and makes potentially a new high, at least back to 460. Now, which one of these two scenarios is more likely? Well, I would actually put forth a third scenario that I think is the most likely. The third scenario is this. Market chops about, tries to rally right before Jackson Hole, gets rejected, comes back down to 422, and then finds a low at 422, and then begins to recover. Forms a huge double bottom with a positive divergence, and then we begin to rally again. I think that's the most likely outcome based on what I'm seeing on the VIX and based on what I'm seeing with the yields and the dollar, both getting closer to a top. Here's the dollar. I talked about this. It moves in 3 successive legs. The last leg of selling in the S&P 500 was obviously made worse by the rise in the dollar. Here's the dollar. We're beginning to print a bunch of indecision dojis at the third leg. That's often when the dollar tops. Okay, I don't think we're entering a bull market in the dollar. Absolutely not. This is the 200-day moving average. I think we'll get another rejection and we'll continue to move down. That's just my opinion. I don't think the dollar is going to enter a bull market because obviously the Fed only has one more rate hike to make. That was it. When the Fed ends its rate hiking cycle, the dollar simply is going to go down. That's what happens. Higher yields sustain a higher dollar. When yields begin to fall back, the dollar will fall back. What's happening with yields? Well, the 10-year yield is now backtesting this exact same high back in October. That's when the market was actually bottoming. That was the bottom in October. And you're looking at the 10-year yield, and the 10-year yield tops here somewhere around the same vicinity, maybe makes a double top, something like that. You would obviously have a medium-term bullish thesis because the market bottomed when the yields topped. The S&P 500 bottomed when yields topped, and potentially now we could bottom at 430 or 422, depending again on what happens with Jackson Hole and with Nvidia, and that potentially could be the medium-term bottom. And as long as we don't take out these lows, we remain in an uptrend. If the S&P 500 takes out these prior lows here, makes a lower high, then takes out these prior lows, the uptrend is over and we're back into a 2022 style bear market. If you find these videos helpful, a totally free way to support the channel is to smash that like button. If you watched till the end and you did not enjoy the video, I thank you for your time and attention. That's all I have for you today, guys. I'll be back, God willing, by Sunday to give you a longer term outlook and a more thorough weekly analysis. Have a good one, guys. Bye-bye.
Oh, wow.